It's all about NBFCs and that IL&FS connection. The morning is not turning out to be that bad. Let's be very, very clear here. Nifty is down 71 points. It's a cut, but it's not like a scary kind of an aftermath of what happened in global markets. It's a weak day. Market breadth is poor. Market breadth has not been the strong point for this market for many quarters now. Dinanath Dubhashi joins us. He represents L&T Finance and Holdings. Mr. Dubhashi, good to have you back on ET Now. Thank you for joining us. Now, profits are better than expected. NPAs are down Q1Q. What are the key drivers? And can you also walk us through that? What has been the impact of in AS?
Worked is absolutely us sticking to our basics. Profit comes from four things. One is good growth, good NIMs and fees, expense control, and last but not the least, good credit quality. So as you see, our growth has continued well. Overall, we have grown by 26%, but within that, rural and housing has grown much more, and the wholesale growth we have kept limited to just around 8%. With this, our retail portfolio, that is rural plus housing, has increased to 47% now. This combined with good control of liabilities, both gaps as well as interest rates, passing on the increase to the customers, have maintained our NIMs and fees, of course. And the hero of the performance really has been asset quality. The gross stage 3, as we call it under Ind AS, has reduced from 11% to 7.1% from last year to this year, and the net stage 3 has reduced from 5.4% to 2.8% this year. This along with a very healthy provision coverage of 62% and a provision of another 200 crores which we carry in addition to this provision coverage for unanticipated event risk. So again, sticking to basics, good growth, good product mix, excellent NIMs and good asset quality control, leading to a 66% growth in PAT and ROE, which we achieved our top quartile ROE last quarter, staying at around 18.47%. Where Ind AS helped us was that in the first quarter we took our entire required provision on our legacy portfolio and hence could lock in into a steady state ROE now. Just basics, good basics of a robust business model working for us. No rocket science.
Right. So, markets are pretty concerned, Mr. Dubhashi, right now on the ALM mismatch. While there is a positive ALM gap for 1 year for you, could you help us understand with how the ALM gap for the 1 month and 3 months is going to pan out? And also, how much short-term money do you have raised in the recent 1 month post the IL&FS crisis?
That in every bucket, my liquidity gap is actually positive. What it means is the inflow from my assets over that period is much more than the outflow from my liability. Simple. So in 1 month period, I have a 10,000 crore cumulative positive gap. In a 1 year period, I have got a close to 18,500 crore cumulative positive gap. In percentage terms, these are plus 150% or so in 1 month period and plus 58% in the 1 year period. So we are extremely comfortable as far as our liquidity gaps are concerned. I will quote 2 more numbers which demonstrate our ability to remain very liquid in even current market. Number 1. As on 30th of September, we are carrying more than 6,000 crores of liquid assets in cash, FDs and other liquid instruments. So you can't argue with cash, right? This is cash on balance sheet. In addition to that, there is more than 4,000 crores of undrawn bank lines and about a 2,000 crore of a backup line from my parent. So that's as far as my comfort on liquidity is concerned. Third, most important is demonstrated performance. From 21st of September, when this whole issue started, till today, we have raised a total of 18,500 crores actually raised. About 4,000 crores of it is market instruments, NCDs and CPs, and about 14,500 crores is mainly bank lines. So one, positive liquidity gaps, actual liquidity on balance sheet as on 30th of September, and demonstrated performance on raising of fresh liabilities makes us quite comfortable that our growth, especially in rural and housing, we will be able to easily support in Q3 and Q4 also out of liquidity that we are able to raise.
Okay. There are also concerns in the market on significant NBFC paper that may have come for rollover repayment over the next 1 to 3 months. How real is this concern, and how much of paper would we see actually coming in for rollover or for repayment from your company?
So, that's what the gap, structural liquidity, by its very definition, doesn't assume rollovers. Right? It is just the difference between your money coming in from your assets, repayment, what you have lent, the repayment coming in, and what you have to repay. So the outflows that you see and you put in structural liquidity are actual outflows. You don't assume any rollover. And that's the point I'm making. Without assuming any rollover, my gaps are positive. Right? If we are able to roll over something, then it will be even more positive. But the assumption is that market instruments which come for repayment are not rolled over. That is structural liquidity. That is what the regulator sees. That is what prudent company sees. And what it really means is the natural hedge coming from the profile of my assets, the repayments coming from my assets are enough to repay my liabilities over the next 1 year period.
Right. Any exposure to the IL&FS group or any entity of the IL&FS group, be it via L&T consolidated book or via asset management business?
My exposure to IL&FS is zero. My exposure to IL&FS financial services is zero. These are the two entities which have defaulted. My exposure to ITNL is zero. My entire exposure of 1800 crores is to 6 road projects. 4 are annuity, 2 are toll. 5 out of these 6 are operating for number of years. 1 is complete and has applied for COD. Okay? 4 of them are annuity projects. 2 are toll projects with track record of 3 and 10 years respectively. The entire escrow, the entire cash coming out of these projects are controlled by us. Not only that, our repayment is totally current, we hold 450 crores in various reserve accounts, our debt service coverage as well as major repair and other reserve accounts. Each of these projects, there is one more thing, 722 crores out of this 1800 crores is in IDF and hence guaranteed by the government. That is number 1. Number 2, each of these projects have positive equity value. And hence we believe that as IL&FS projects go for sale, these may be the first projects which will get sold, and we might get actually even prepaid. And as the refinance opportunities come, there might be even fee opportunities for us. Very simple. In conclusion, the exposures to these particular road projects are so well structured and so well protected that we expect zero losses, nil losses from these projects.
Right. What has led to the gross stage 3 NPAs to come down? Which segments are showing improvement? And would you have to make additional macro provisioning in Q3, Q4 besides the 110 crores that you've accounted for in Q2?
GS3 has improved. Gross stage 3 has improved in every segment. Why it has improved? One is because of higher collection efforts, but more importantly, continuously concentrating on early bucket, on zero DPD. We firmly believe that NPAs don't come down by concentrating on NPAs. NPAs come down by concentrating on zero DPD. If you don't allow your loans to become bad in the first place, you don't have to cure them. So that's our philosophy, and that has led to this continuous improvement, and it is across businesses. Rural and housing, of course, the improvement is there. Wholesale, we disclose the entire NPA, S4A, everything, even standard assets, which we believe are stressed. Everything we disclosed at the end of Q1, and then we said this is it. From here it will continuously reduce, and that is the trend that we are seeing. So that is number 1. Number 2, we have made adequate provisions based on our models for these assets. So our provision coverage has actually increased from 63% last year to from 53% last year to 62% now. That is number one. Now talking about macroprudential, the whole idea of macroprudential provisions is these are not provisions that you need. These are provisions that you can make, you can afford to make. The whole idea is being humble and saying that there can be situations like floods, earthquakes, etc., which you can't predict and hence you can't model. And when such big things go wrong, you should not, your P&L should not get the shock. You should always carry something on your balance sheet. You can call it counter-cyclical, you can call it provision against unanticipated risk. And what we believe in is that these are the times when we are making good money, good profits. These are the time that we should keep some for such events. And in the first quarter we kept 90 crores. In this quarter we have kept 110 crores. So we are totally carrying about 200 crores of provisions which we can't model, and we humbly say that we can't model. These are unanticipated events, and for that we are just keeping this protection.
Okay. So how do you read the current liquidity crisis for the NBFC sector?
See, you know, the regulator has already taken some steps, and I'm sure it will take even more steps. But I look at every crisis. I mean, we, over the last 2.5 years of the history of this company's good performance, there have been various crises. I mean, we are talking about these crises today, but demonetization was perhaps had even more effects on the industry. GST, RERA, farm loan waivers, they were one after the other, Ind AS implementation. Every quarter something or the other is there, and we look at every crisis as something which will differentiate good companies from bad companies. We know that there are peers who have longer performance records, and we look at these crises as an opportunity to fast forward our pedigree and show that we can perform well even through this crisis. So I wouldn't say I welcome the crisis, but I would definitely say I look forward to them, such crisis, as an ability to show that L&T Finance Holdings can give differential performance and prove and stamp our pedigree.
Mr. Dubhashi, glad that you could take time out and speak with us candidly about your earnings and really what's going on with the entire liquidity environment currently. Good to speak with you.